Welcome to Slaying the Safe Exam through 57 high priority safe exam mortgage terms. My name is Rich Leffler, and I am the senior instructor and founder of Accelerated Development, helping people pass the safe exam for over 17 years. Let's jump into qualification and ratio related definitions, and today we have 6. Number 1, debt to income or DTI ratios is an indication of a mortgage applicant's ability to repay the debt that he or she desires by comparing his or her monthly expense obligations to his or her gross monthly income. Housing expense front end and total expense back end DTI ratios. With the exception of the VA loan, the mortgage industry uses 2 debt to income ratios when determining the creditworthiness of an applicant applying for a mortgage. The front end or housing expense ratio is the cost of owning the property in relation to the applicant's, and please note that's plural possessive, gross monthly income. This represents the total cost of owning the property, all mandatory expenses associated with owning the home, regardless of who's responsible for paying it. Either the borrower pays it directly to the individual or entity to whom it's owned, or the lender pays it on the borrower's behalf through their escrow account. That's irrelevant. If it's a mandatory cost associated with owning the home, all of those expenses get added together, and the total gets divided by the applicant's gross monthly income. The back end or total expense ratio is all costs in relation to income. So here we have the complete housing expense plus consumer debt plus long-term debt. And then that sum total is divided by the applicant's, again, plural possessive, gross monthly income. And that gives us the back end ratio. Credit score is a numerical representation of the subject's creditworthiness. Everybody has 3 credit scores. What we typically do is look at the middle score to determine whether or not they're credit qualified. If there are multiple applicants, we use the lowest of all applicants' middle credit scores because, of course, a chain is only as strong as its weakest link. Loan to value or LTV is the loan amount in relation to the subject property's value. It compares the borrower's equity in the property to the lender's equity in the property. And with every amortizing payment that's made, the LTV gets lower and the borrower's equity share gets larger. Combined loan to value or CLTV represents all outstanding property-related debt in relation to the subject property's value. And finally, high loan to value, HLTV, which is synonymous with high credit loan to value, HCLTV, which is synonymous with total loan to value, TLTV, 3 names of the same thing, represents all outstanding property related encumbrances in relation to the property's value. If you would like a video through which I go into much greater detail on all of those and more, look in the description and you'll find a link to our mortgage math video. So not only does it describe what those things are, it shows you how to properly calculate them. Aside from that, if you're in need of any other resource or service as you prepare for the SAFE exam, reach out to us here at Accelerated Development, www.safeexamtraining.com, where we got your back, Jack, when it comes to preparing for the SAFE exam. Good luck.